Well, hello, Michael. Great to have you back again.
Hi, Simon. How are you?
I'm very well, thank you. Wanted to start today talking about the central banks and I guess the dilemma they've got now with some of the conflicting data that's out there. What are you seeing?
Look, I think the balancing act for central banks is definitely getting more challenging. So I think in the last, particularly 3-4 months, there's most probably more signs of some inflationary pressures. And the main ones, we've seen a lot of commodity price rises, particularly in certain foods. But we're also seeing freight costs going up, partly due to oil prices rebounding, but also container shortages globally. That's making supply chain restocking more challenging. So there are some, and then obviously we've seen asset price rises, particularly in housing. So there are some, I guess, challenges on the horizon. I think the central banks will try and look through any uptick in inflation, providing they are comfortable it's a shorter term and not a longer term sort of trend that may sort of get a bit out of control. But it's certainly on the radar where it wasn't really even 3 to 4 months ago. And the best indicator of that's been the rising bond yields, particularly at the long end of the curve. The short end still very much part of yield curve control and quantitative easing. But as you go out beyond sort of 3 years, and particularly out in the sort of 10 years, we've seen a fairly sharp steepening of the yield curve and rising long-term bond yields. So I think they are certainly caught up in a bit more of a challenging environment, and they're going to clearly pay close attention to the key economic data. If you look at what the closer to home with the RBA, they're continuing to very much base their comfort of not raising rates to 2024 at the earliest on unemployment not getting down to what they classify as full employment. So they're saying full employment's 4 to 4.5%, but possibly even in the high threes. Now, we haven't been at those levels since well before the GFC. So they, as a result, their argument is without wages growth, and to get wages growth meaningfully above 2.5–3%, you really do need a tightness in the labour market that we currently don't have because there's too much unemployment. Their argument or comfort around inflation is that that's not going to happen for some years, and really without that, you're not going to get inflation sustainably in their 2 to 3% band. And really you'd need it at the upper end of that, I think, for them to start feeling like they may need to raise interest rates. But I guess the trick with that is, as I mentioned, there are some other inflationary concerns. And I think the central banks are getting a little bit more wary. And it was interesting, the Fed chairman Powell last night made a comment that US inflation is not expected to surge out of control, to try and take a bit of heat off the bond market. Yeah, because they don't want yields rising too quickly and too far, because that can start to really impact valuations in equities, long-term investment decisions as the discount rate rises. So, as I said, they've really got a delicate balancing act. The other key watch out, I think, for Australia with the RBA is they're currently been targeting the April 2024 bond, which is the 3-year bond today. Now, as that sort of becomes less than 3 years, if they want to try and maintain that 3-year bond virtually at the cash rate of 0.1%, they'll at some point have to potentially move out to the November 2024 bond to keep that longevity in what they're doing and better yield curve control. So markets will be watching, particularly most probably in the next few months out around August, to see if they start shifting their bond buying program to the November 24 bond, and also if they start to change amounts that they're doing each month. So that'll be closely watched, because if they start to go at the shorter end of the curve or reduce the volume of what they're buying, that may flag to the market that they are a bit more comfortable with those bond yields at the shorter end starting to pick up. And that may happen, that could be 18 months before they even start to think about raising rates. But I think the markets will be closely watching that.
Definitely. And what does that mean from an FX perspective then?
Well, the FX market, if you look at the Aussie dollar, we did hit 80 cents earlier this year. And if I told you back then that actually today or last night the US equity markets would be at record highs again, I think they've made 3 record highs. Certainly the S&P has, I think, this week. You would have thought the Aussie dollar may be testing that 81.5 cents level where it's topped out 3 times sort of in the last 6 or so years. But we have seen a bit of a rebound in the US dollar, partly due to the rising yields, bond yields, but also their data, even the last week or so, their March payrolls rose by over 1 million people, and their ISM, which is a manufacturing survey, is at a 37-year high. That combined with all the fiscal stimulus in the US and the vaccine rollout, even potentially exceeding expectations, is sort of really ramping up the prospects of US growth outperforming, and that's partly behind the equity hitting all-time highs there, but it's given the US dollar a bit of a leg up. That combined with a bit of a commodity price pullback, commodities had a big run up. We've seen pullbacks in base metals like copper. Certainly we've seen it in iron ore. We've seen it in some food commodities, even in oil, about 10%. So all those things are sort of have brought the Aussie dollar back to around 76.5, but we did get to the low 75s last week. So in terms of risk appetite, you'd expect the Aussie to be a bit higher, but in terms of some of those other fundamentals I just mentioned, it's been drifting lower, albeit it's holding well against the cross rate, so it's not just an Aussie dollar story. And my view still is I think the Aussie still looks like it's going to be strongly supported around the low to mid 75 cent levels. But I think for it to push to test that 81.50 is maybe not looking as compelling as it was a month or two ago, because there are a few sort of headwinds there. But it does have a very positive global backdrop of growth, fiscal stimulus, lots of liquidity, risk appetite. So providing commodity prices don't sort of have a really deep pullback, or there's no other sort of surprises, I still think the Aussie dollar can at least retest up towards the high 70s and potentially low 80s.
And you just mentioned commodities. There's been a pullback there. How have you seen that market?
Well, I guess that's not that surprising for 2 reasons. One, we've seen a bit of a bounce in the US dollar. So you do get sometimes an inverse relationship between the two because commodities are obviously priced in US dollars. So if you get a stronger US dollar, you can get some offsetting weakness in US dollar price commodities. And I guess the fact they'd had a massive run up is not overly surprising that they were going to pull back, albeit for different reasons. So if you look at, say, crude oil, OPEC, I think this week announced about another 2 billion barrels a day that they'll supply from May to July. There have been some setbacks to the emergence from COVID, such as vaccine shortages in some countries. There's mutations, and that continues to be a risk. The container constraints that I mentioned before, which are impacting trade, and I guess continued travel uncertainties. So that's not particularly surprising. We've seen a bit of a pullback there. Iron ore is still relatively strong because of Brazil's a key supplier, and COVID in Brazil is a major issue. However, there are some concerns around Chinese stimulus measures being removed, and that, and I guess increased supply over time, should see iron ore prices continue to fall. But we've even seen copper and some of the base metals pulling back again on some concerns around Chinese credit and I guess related infrastructure there and demand. The one that has gold also hit a 6-month low, but has bounced back a little bit recently, and food commodities led by mainly corn and soy, which are up over 50% in the last 6 months. Corn's still at its pretty well highs, but wheat, soy, and some of the other foods have drifted back. Lean hogs are also at really, they're at high, multi-year highs through to African swine fever in China and concerns around that. So, commodities clearly, some of those pullbacks are behind a bit of the Aussie dollar weakness. but you can see the concerns with central banks with food commodities or freight costs, because they're very hard for people not to pass on. The other red herring with inflation is insurance premiums are really jumping up dramatically. And so for a lot of businesses, there is risk that they start to pass on pricing as demand picks up post-COVID. But they also are faced with, I guess, job seeker being wound back, or JobKeeper, and also some early signs of consumption actually weakening a little bit in Australia. So I think, again, it's going to be really interesting to watch inflation trends.
Definitely. And so from a corporate treasurer's perspective, what should we be keeping our eyes on in the coming month?
Look, as I said, the data's still pretty strong. I think in Australia, certainly, I think unemployment, I think the most recent number was 5.8. It fell from 6.4 to 5.8. But with JobKeeper and everything else, it's most probably hard to see unemployment really being a lot lower than that at the end of this year. But if we get that wrong and it drifts towards the low to mid fives, that starts to again make the central bank outlook a little bit more challenging if they can keep rates here for 3 years. I think anything on the consumer side, so consumer sentiment, retail spending, consumption, I think will be important to watch. I think also the housing market, the RBA have mentioned that in their most recent statement, and certainly interesting to see what New Zealand did the other week when the market was starting to think with their prices, which are actually have been going up more than Australian, that they may have to do something on rates. They came out and made a whole raft of tax changes around negative gearing and capital gains tax. That caught the market on the hop, and the Kiwi dollar sold off quite dramatically. But it just shows you that central banks would be very reluctant to have to raise rates. So they would look at maybe prudential lending controls or other measures. But I think anything involving them, their quantitative easing and bond buying programs, anything they're flagging to the market, I think people need to watch very carefully, not just from an interest rate view or yield curve, but also from a currency perspective. COVID trends, even though people are ignoring them a bit, I mean, we've seen it this week in Australia, the AstraZeneca setback, as they're now saying, if you're under 50, that they don't think you should be using that. So that any delay there means we may keep borders shut for longer, and that has impact. So I think anything to do with that, the geopolitical, I think, is the final one most probably, and I think there's a lot of geopolitical areas with the Middle East, Russia and the Ukraine, China, Taiwan. You've got a new regime in the US. Anything that can affect risk appetite or growth forecasts, I think, are worth watching. The final thing I think for risk appetite, the two things I'd keep an eye on are the equity markets, particularly the NASDAQ. That's most probably the best gauge there, and credit spreads in the debt markets. I think they're most probably the two things to keep an eye on that side.
Michael, as always, it's a pleasure. Thank you very much for your insights, and I look forward to chatting to you next month.
Thank you, Simon.